Hello and welcome to Commodity Culture. We are kicking off our 2023 Sunset series where we invite experts in the commodity space from a variety of sectors onto the show to give their year in review of 2023, talk about what surprised them, what went according to plan, and any insights they gleaned from the events that transpired that will inform their investment decisions moving forward. And I can think of no one better to kick off this series than my good friend and the founder of the TF Metals Report, Craig Hemke. Good to have you back on the show.
Jesse, nice to see you, my friend. Happy holiday season.
Yes, you as well. And let's start by taking a look back at 2023 first and get your take when it comes to the precious metals space and the economy at large and markets. What went the way you thought it would? What surprised you?
Well, for me, this is a little easier task in that this site of mine I've been running for 13 years. And about 6 or 7 years ago, I started kind of compiling my thoughts at the beginning of the year into what I call my macro cast. And on the surface, it's no good at all to do that because if you're right about events over the course of the year, it's not like you get a bunch of attaboys. But when you're wrong, everybody can go back and say, geez, what an idiot this guy is. He's a dope with a MacBook. But I do it for myself primarily. Because everybody's going to make mistakes along the way. But what do they say? I mean, if you can learn something from your mistakes, then, they're worth it. And so, by writing the macrocast, it gets me on the record as to what was I thinking as one year ended and the new year began. So that then I could go back and review it and go, okay, you sure got that part wrong. Wow, what was I thinking? And learn from it for the next time. So in this year's case, I'll obviously be looking at it. What's curious about this year is I don't really know if I was, this sounds like standard gold bug, a kick the can kind of thing. There are a lot of people like me that are like, I don't know what I got wrong over the last 12 years. Well, it's not so much that you're wrong. It's just that this exponential growth of the debt, and the accelerating death of the system just takes a while. And kind of on a microcosm of that is my forecast this year. I didn't know that, after what happened in 2018, I didn't think the U.S. economy could, and the markets really could take interest rates much above 3%. So I figured we'd be there by spring and by the summertime, it'd be obvious impact of the economic slowdown and the Fed would pause and start talking about cutting. It's been delayed by about 6 months. I mean, where we are now, late November, rolling into early December is about where I thought we'd be by like June into July. So I don't think I was necessarily wrong on the forecast for this year. I just think I was early. And so now I'm looking forward to next year to seeing gold move out above 2,100 and drag silver with it.
Well, when we look back on 2023, are there any insights that you gleaned from the events that had transpired? Maybe we can focus on the precious metals here, but also maybe on the broader commodity space. Is there anything you were able to glean that will inform your investment decisions moving forward in 2024?
Well, let's start with the broader commodity space. I guess in a way I could have been more dead wrong about copper. I read a lot of stuff in the first part of the year about dwindling physical copper supplies. Goldman Sachs even was saying that, as if they're trustworthy. But anyway, even they were saying that existing copper stockpiles would be dried up at their current use by August or September. Well, hell, here we are in November, and apparently there's still plenty of copper around. So I had that as part of my thesis this year, that, copper would kind of drag silver and the commodity run would be stronger than it's been. Other things that I can learn going into next year, again, is it's just a really good reminder that I'm thinking, about the old adage about history doesn't repeat, but it rhymes, and I was really convinced that the U.S. economy and the bond market, the markets in terms of liquidity and everything else just couldn't handle a move to 5%, even temporarily, on like the 10-year note or even the 2-year note. And I guess what I failed to take into account as I've looked at it is all of that cash that was created and flushed out into the system post-COVID that turned into excess reserves at the banks that the banks then parked at the Fed in that reverse repo program. And it got to, by earlier this year, with $2.2 trillion on that overnight reverse repo. And in the end, that kind of turned out to be like a piggy bank of, kind of quarantine dollars that allowed the markets to maintain liquidity, even though the Fed hiked rates up. So and now it's down to like 950 billion. So it's been more than cut in half over the last 8 or 9 months, and that looks like it's headed to zero. And when it does get to zero next year, what choice is the Fed going to have but to turn on the liquidity? So I think that was the part I missed, understanding that it's not always the same. In 2018, there wasn't that level of cash just sitting there parked at the Fed to provide emergency liquidity for the markets. And so I missed that. And then, like I said, that the economy was maybe a little more resilient. We got this spike in improving economic data back in the late summer and into the fall, and that allowed the Fed to kind of change their forecast, and that change in rate hike expectations and pushed them back. And like I said, all of it combined to kind of forestall what I thought was going to happen by 5 or 6 months. But the good thing is it's still going to happen. I still feel pretty good about how prices are going to trade, especially in the first half of next year.
Well, looking ahead to next year, what do you think the main commodities are that could perform? What do you think could underperform? Do you think the copper thesis will play out eventually and it's only a matter of time? Maybe we could see that shortage occur in 2024 or later. And what are your thoughts on gold and silver here over the course of 2024 and how you see them performing?
Well, regarding copper, I just, I don't follow it closely enough to be able to speak to it intelligently. I just took some outside sources and thought, okay, this all makes sense. Sure. And yet here we are. What is it, 370 or 380 a pound? And, it's doesn't appear to be going anywhere. Crude will be interesting to watch. I find it interesting that even with all the unrest in the Middle East, crude just went down, is now even lower than it was in early October. All while after the White House had instructed, to dump at least almost half of the U.S.'s strategic petroleum reserves, price remains under pressure. But we also just heard about renewed production cuts coming out of OPEC. So crude will have an interesting year next year as well. What I'm most focused on, though, obviously, is the precious metals. And I still think what I expect is going to play out. Gold has been in a trading range, really, for the past 3+ years. Some people would try to say, oh, God, look, there's a triple top. Actually, it's like a septuple top. There's like 7 times gold's gone up to 2,000. Well, now that, as we're recording this, 8. It's in a range, okay? There are double tops and double bottoms. Anything beyond that is just hokey pokey. It's in a range. What typically happens, and I've seen this, Jesse, I became a stockbroker in 1990, okay? So I've seen this play out a few times in my life. When something is in a range for a long period of time, or not even that, if it just moves forward and makes a new all-time high after a period of consolidation, that new all-time high generally creates some positive buzz, right? And people are like, ooh, I'm missing out. They're seeing the headlines. Oh, look at the new all-time high. So think of that with gold. Gold finally breaks out of the range, comfortably north of 2,000, pushing 2,100. The headlines are going to be everywhere. Gold breaks out, new all-time highs, right? And people are going to start going, maybe I should get some of that. They don't want any of it at 1,800, right? Here in the West, maybe I should get some of that. Call their stockbroker. How do I get some gold? Well, we'll buy you some Newmont. This kind of thing starts to happen, and it creates its own buzz. Generally, when you make a new all-time high in anything, look what happened what's been going on in orange juice. It creates its own momentum, and you get at least a 10% follow-on rally. Just the surge of momentum and optimism and all that, late people chasing it, that kind of thing. So let's say sometime in the first half of the year, gold gets to 2,300, just on that surge that I would expect. I just don't think there's any way that the gold-silver ratio at that point is going to be 100, right? So what would be a good number for that? 80? Silver's going to come along, and then so it's going to do the same thing. It's going to break about 28 finally, 29, and all of a sudden it's going to have a 3 handle, and then it's going to jump too. So To me, this is a pretty clear trade that's coming. Lots of profits that can be made trading maybe the mining shares as well. And then we'll see, what happens once we get to 2,300 and 33 or 4. Then we'll have to see where we go from there. But I feel pretty good that that's what's coming.
Moody's recently downgraded the US credit outlook to negative, and the reason was polarization. It's important to truly grasp that the world is afraid not of the size of the national debt, but of the lack of any plan or willingness by either party to even address it. It scares the living daylights out of investors, and that means that for the next 5 to 7 years, at the very least, the dollar will lose 4 to 5% per year, which will wipe out 30% of your savings after tax. That's a hell of a debasement, and it means mining stocks are likely about to finally go on a parabolic spike. Our good friends at wealthresearchgroup.com have put together a report, an exclusive one, detailing exactly why, what, and when. Download it for free at wealthresearchgroup.com/boom. Link is in the description below. I'd like to discuss the gold and silver mining equities a little bit as well. You touched on that. You mentioned Newmont. How do you feel about the sector as a whole when we go down to the junior mining space, obviously the more speculative space? A lot of people are pointing to the fact that it's extraordinarily undervalued compared to the physical metal, even when you move up to some of the development space. And so I'd like to get your thoughts on where you personally allocate capital within the mining sector. Do you look to the more speculative junior mining exploration space? Do you look at the larger miners, the producers? Do you look at royalties, ETFs? How do you approach that?
I hate the mining space. That's legal to say. I mean, it's just, they'll just rip your heart out, right? And talk about learning from mistakes. Okay. I, again, started the site in 2010. By early 2013, I just said, oh, to hell with it. These mining shares, they just blow. I don't want anything to do with them. Then, all of a sudden, at the late 2015, I got a check in the mail from a former employer that bought me out of their responsibilities in their defined benefit plan, their pension plan. Said, hey, you want a present value check for what, your future payments? Sure. So they sent me $55,000. And I rolled it over to an IRA. And as fate would have it, it was serendipitous, whatever. That was the lows. I mean, remember the Hui in January 2016 got to 99.19 on the 19th of January. So I remember this pretty well. And I bought, I just kind of spread it around. All these years later, I just looked at it this morning. It's $120,000. So, okay. So I've more than doubled my money in 7 or 8 years. So that's about what you should do. Everybody at my site, all the members of my site, have access to look at all my holdings. But I can tell you, it's generally spread about half and half between, Agnico Eagle and Franco-Nevada and Newmont, and bigger cap producers down to the juniors, and then some exploration companies that I feel like I know a little bit about. But where I keep screwing this up, Jesse, like everybody else, is every time they roar, like over like a 9-month period, I'm like, here we go. This is the time, right? And then, I mean, if I just, blew them all out in, the summer of 2016 when the Hui, had tripled, and then bought back in 2018, then blew them all out again, in 2020, but I'm a believer, right? And so that's what I can't seem to learn from. To what the current day is, we are on another one of these 9 months, face rippers. The chart, like of the GDX, is beautiful. It's got another island reversal on it. There's 3 of them this year. That the previous 2 have led to a sharp rally. Even this current sell-off has got a textbook reverse head and shoulder bottom. All the GDX needs to do is get above 30 and looks really good. They'll struggle again because this period, late November until about the middle of December is when you get tax loss selling. And once again, everything else is done fine, but the mining sector is stunk on ice this year. So there are losses to take. But once we get, into the middle part of December, I'd look for a late year rally, and the GDX gets it above 30. And once it's above 30, it should look at 33 and 36. And if I'm right about gold going to 2,300, probably get back into the 40s. That's that's a 50% rally from here at least. And that's just another one that, will I be smart enough this time to probably not. Given my track record, I'll be like, oh yeah, we're going to 60. So we'll see.
Is 2024 finally going to be the year that we see this impending recession and broad market crash? There's been a lot of hyperbole, everything from the entire economy is going to collapse, the financial system's going to collapse, to there's going to be a recession, there's going to be a deflationary depression. I've spoken to a few people who say, no, actually the soft landing scenario is actually possible, and this time it's different. And, it's interesting because when people say this time it's different, there's always this, connotation that they don't know what they're talking about. But as Howard Marks has pointed out, about 20% of the time, this time really is different throughout history. So what do you think? Is the soft landing scenario possible? Do you expect this coming market crash to finally arrive in 2024? What are your thoughts?
I would start out by saying these things are not mutually exclusive. Okay, you can have the economy go in the tank and not have a market crash. Okay, and that's where I am. Look, to me, the paradigm change, and I still am amazed by the people that don't seem to understand or appreciate this. In 2009, coming out of the great financial crisis, Ben Bernanke rolled out QE, ostensibly just to save the banks with TARP and all that kind of stuff, right? That had blown themselves up with all their derivatives and credit default swaps and everything else. Well, it was a one-off. Just we're not monetizing the debt. We'll never. Right. Here came QE2, and then all the other shenanigans in between, and then anyway, here we are. Okay, the Fed has shown since the paradigm changed 15 years ago that when push comes to shove, they will act. Hell, just go back to March, right? They suspended their QT. A couple of banks get in trouble. They suspended QT. They got to roll out this near-term funding facility or whatever the hell it is. It's now got $115 billion of underwater securities in it. They will do whatever it takes. Okay? So back in the day, let's see. U.S. economy's in recession. Okay, and there's these things called PE ratios. And E is earnings. And if we're in a recession, then that means earnings are coming down. And so that means the PEs are... that's how it used to work. And there was when we talked about fear versus greed, we talked about actual fear of losing your ass, right? Getting your 401k turned into 201k. Remember that old joke? Now the only fear in the market is fear of missing out. The Fed's going to switch and boom, up we're going to go again. I'm not saying that's the right way to look at it, but that's probably the correct way. That probably is what's going to happen. So the U.S. economy goes in the tank, but as long as the banks are okay and the Fed's going to make sure that's going to happen, the markets will probably stay elevated, be bought on the dip like they have the last couple of times that we've had a 15, 20% correction in the last 2 years. Turn around, right, go back up. So anyway, to answer your question, yes, there is a significant recession coming, and it's a stagflationary recession, and it's going to be brutal. Not for the people that actually own stocks, but for the 65% of Americans that don't even have $2,000 in savings that they can tap if all of a sudden they need a new set of tires on the Impala. Okay, this is a very mean time that's coming, and it's an election year too. The Fed will move to keep the markets afloat, and that will keep the stock market afloat too. Okay, and that's going to be very beneficial for gold too, because more and more people are like seeing the curtain pulled back and figuring out how this works.
Well, following up on that, is 2024 the year that we see the Fed and perhaps the ECB as well start cutting rates, or will the higher for longer rhetoric actually play out? And in both scenarios, what do you see the impact being on gold and silver?
Yes, they will. They will cut rates if they feel like they have to keep the economy afloat, more importantly, keep the banks afloat and keep the markets liquefied. Period. End of story. Again, I talk about learning from history and how it doesn't necessarily repeat, but this is what the history has been for the last 15 years since the game changed. Okay, they'll do it again. The people that think, oh no, they're going to take rates to 8% because they got to get rid of inflation to help the little guy. They don't give a shit about the little guy. They want to keep the markets afloat. They want to keep the banks greased. Okay, that's what they care about. If they can help a few little people along the way, ahoy polloi, they'll do it. But that's not their concern. Okay, they want to think the rising tide will lift all boats. We'll keep the markets afloat and the little bit of equities, that those 65% of the people own in their little itty bitty 401k plan will do better. So they will cut rates. Now, where I was wrong with my forecast this year is that in June, the June FOMC, when the Fed put out their SEP, their Summary of Economic Projections, they were projecting the Fed 4 cuts in 2024 and 5 cuts in 2025. Then all of a sudden the data gets a little bit better. I don't know what to do. And then by the FOMC in September, they cut it to 2 projected cuts. So again, still the Fed is even saying. Well, anyway, with all the lousy data that's happened since, it will be interesting to see what the FOMC states in their SEP in December. But the market already is telling you that, Jesse, right now on the forward Fed funds projections, there's a 30% chance of a 25 basis point rate cut in March. All right. And already back to projecting 3 or 4 rate cuts next year. So again, what do I know? Okay, it says right here, dope with a MacBook. Okay, that's me. I'm talking to you on said MacBook. I mean, a lot of smart people out there, way smarter than me, that think, oh no, they're going to hike and they're going to keep it high and all that. Knock yourself out. I'm just telling you what history has shown, and I don't suspect this next time is going to be any different.
And so in that scenario, is that when gold and perhaps coincidentally with that silver often lags gold when it comes to the precious metals bull markets. So do you expect that sort of environment where they start to cut rates to be beneficial for gold and silver? What are your thoughts there?
Yes. Talk about the stock market, and it's people fear of missing out, right? Waiting for the Fed to cut, I don't want to sell because pretty soon the Fed's going to cut and then I'm going to be chasing and all that. Same thing as gold this year. I mean, it's not just the fear of missing out that's kept gold afloat. Okay. I mean, you've probably seen the charts, gold tracks real interest rates like this. And then all of a sudden there's this big gap, right? That at this level of real interest rates versus inflation expectations, gold should be $1,200. Why is it not $1,200? It's $2,000 instead. Well, there's a number of reasons for that, but one of them is fear of missing out. I mean, why would I sell my gold when I know that the Fed's going to be cutting next year and prices are just going to go higher? So yes, this change in inflation expectation, interest rate expectations, that buoys gold and eventually drives enough institutional buying of the futures contracts that it gets permanently above 2,000, which maybe begins in December, and then stays there. And then all of a sudden, you're closing the month above 2,000, you're wrapping up the quarter above 2,000, and people start going, and you get more and more people going, which is already, to double the amount of people that are excited about gold isn't very challenging because we're starting from a pretty small amount of people in the first place. And then it kind of feeds on itself. And then, like I said, you get $2,100 gold, new all-time highs, people talking about it. And you see 2,300, 2,400 pretty quick. In the matter of a couple of months. And I think that's what's coming.
You mentioned institutional buying. 2023 was a record year for central bank gold buying. Do you expect that to continue in 2024? Do you expect more institutional inflows into gold as perhaps a wealth preservation asset, as a flight to safety asset, as the debt situation in the U.S. continues to kind of seemingly spiral out of control? And do you think there will come a day, perhaps in 2024, when we see larger allocations from institutional investors to the silver space as well in some form or another?
Well, the latter part of that's a tougher one. I think the first part is pretty easy. Yes. You and I on my site, whatever, and there's countless other people you talk to. What do we tell people to do? Take some of your money. You don't put all your money in gold, right? You don't put all your money in anything. But take some of your savings that you're holding dollar-based, right? Whether it's in stock, fiat-based, I don't care where you're listening, euro-based, whatever, yen-based. You're holding yen, you're holding euros, you're holding dollars in the end. Take some of that and get out. Those things are being rapidly devalued, and it's only going to get worse. Take some of that and buy some gold. It's exactly what the central banks are doing. They accumulate dollars in their foreign currency reserves from international trade, and they're like, well, we don't really want to keep holding these, and we sure don't want to put them in treasuries. Let's buy some gold. So I don't see why that trend changes. And we already had the biggest year since 1968 last year in terms of central bank gold buying. It's going to be beaten this year by the time it's all said and done. Probably beaten next year too. And that's all part of the reason why you haven't seen gold go to 1,200 this year. Because there's just not that much physical metal laying around that these central banks, they want the real thing. Now, whether that then leads to hedge fund, and greater acceptance and buying gold and getting excited about it, well, there's lots of room for them to come in. Current open interest in COMEX gold is about 480,000 contracts. I've seen that over the time I've been doing this as high as 800,000 contracts. Okay? The net long position of the hedge funds and the large speculators in gold is not even half of what I've seen it reach. So there's all kinds of room for, buyers to come in and drive the futures price higher. Now, finally, does that extend to silver? I don't know. And you remember the one time everybody about fell out of their chair, that guy Minard, who's now passed away, but Scott Minard of oh God, now I'm having a brain fart, what his company was he worked for. Anyway, he's at Davos, on CNBC like 3 or 4 years ago, and he goes, oh, my favorite trade of the year is silver. And I mean, like, the people just, they like had a stroke. That is how they don't even think, it's not even on the, not even thinking about owning silver. Okay. Now, again, silver breaks out, gets into the 30s, and that's where you get these periods like 2011 where it goes from the 30s to the 40s and all this. Silver went from $18 in late 2010 to $48 in April of 2010. So you get these, rushes of speculative mania. And we can always have one of those, especially if I'm right about gold and that, what we said earlier about the gold silver ratio, and, silver all of a sudden is above 30, it can feed on itself. But to project that, I've learned over the years, obviously with silver still being where it was last year at this time, and that sort of thing, to project that's pretty hard to do.
When we look out at the retail investor space, do you think we could ever see a day where, a lot of people talk about Tavi Costa as one, there's many people that discuss a trend that they see occurring moving forward of a shift from overvalued tech stocks, the Magnificent Seven, to real assets in the forms of commodities and commodities equities. Could we see a world where Jim Cramer is talking about which of his favorite gold mining stocks is a buy or a sell? Do you think we'll ever see the commodities enter into the mainstream as the big tech stocks have thus far?
In the end, in a broader picture, Tavi's argument is kind of a growth versus value thing, equity argument. That always, again, I got my Series 7 license in June of 1990. It might as well have been June of 1890, compared to, for just that way the markets operate and the change and the investing allocation that people do 30 years later. And that used to be the thing, you got some growth, some value, and it's a barbell strategy, now it's just like, look, if I don't double my money in a month, that stock's a, dog doo-doo, right? Nobody, remember that I mentioned earlier, my IRA going from 55 to 120, remember the rule of 72? If you could double your money in 8 years by averaging 9% a year. But like I said, now, if you don't double your money in a month, get me out of that. So the whole idea, anyway, my point in all this is that's the growth versus value thing, right? And that's kind of what you're trying to recognize in the mining sector. Look at the value. Look at all the cash that the cash flow that the miners hold, and the price and, blah, 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 blah. Now, all that said, when I'm right, early next year, and gold breaks out above 2,100, and it's generating all these headlines, you will see Cramer on Fast Money and some of the cats, that are on that show talking about it. and talking about, oh, look at this chart and look at Newmont, historically largest miner in the world, and look at it's only trading at this PE with this level of dividend. That will happen. That will happen. It won't be a regular part of the conversation though until we really get into that secular period again, like I think is coming. Where gold goes to 3,000 and 4,000. And all commodities are going, and financial advisors are actually allocating money to commodities rather than just some fringe play to keep their customer happy. But that's more of a secular change. And what I'm talking about for the first 6 months of next year and maybe beyond is not that yet.
Well, the goal on this show is to make the viewers better investors in the commodity space. I think that our conversation so far has provided a ton of insight that will help people with that. But before I let you go, I wonder if you have something you could leave us with, whether that's an idea, a strategy, perhaps a mistake you see people making very commonly, or another piece of information you could leave with our audience when it comes to the precious metals in particular, or any other sort of investing.
Well, okay. I hadn't thought about that, so this is just what's right off the top of my head. Don't fall in love with a trade, right? This time, it's probably not different. As I mentioned earlier, I thought we were ready to roll, in the summer of 2016. And I certainly, God, you think back to that summer of 2020, and COVID and all this kind of stuff, and they couldn't print cash fast enough, and man, everything looked great. And then there was, I think it was in August of 2020, all of a sudden, gold and the GDX both just got slammed for a couple of days. That was it. Okay, and no amount of hope and everything else could keep it back up, get it to go back up there. So there will come a time next year, not that the long-term trend isn't favorable and all the stuff that we talk about, but there will be a time to take some chips off the table again, and again, so don't fall in love so much with the trade. And then finally, the other thing is, when we get into one of these periods again, and this kind of goes with the first point, do not over allocate yourself to anything. I still see people shooting tweets at me, I bought all my silver allegedly at $42 in April of 2011, and it's still only $24. And I'm like, really? You didn't buy any on the way up, and you haven't bought any since, like when it was at 14 or 15? So never get beyond, your own, investment, time horizons and risk tolerance and everything else that goes with it. You always have to do all your own due diligence on an idea, and you always must keep from getting, greedy. Again, assess your time horizons, assess your risk tolerance, and then you can trade accordingly. But man, I don't care how great the metals look at any one point in the next 6 months, man. You're still going to have to be cautious and wary and understand how those markets operate.
Well, excellent words of wisdom there, and a great note to end things on. Before I let you go, could you tell us about the TF Metals report and what it's all about?
Now, this is a lot of what we do. Again, I mentioned you can see it on the banner, established 2010. I mentioned how long ago it was I got my Series 7. 2010 might as well be, 1950 at this point. I mean, it just seems so long ago. But we keep soldiering on because it's the idea behind it is that we're all in kind of the same boat. We're at the end of the great Keynesian experiment, and that not only is the debt exploding, but the cost of servicing that debt is exploding, and that just makes everything spin that much faster. Someone has to be the last buyer of that debt, and that's the Fed. And all of these things augur toward having an exposure to gold and silver. I do that analysis every day where we talk about price. Is this a good time to buy some, or is price going to pull in, a little bit? Maybe you can save $1, in buying your silver, or $50 in buying gold. So I do that. The community of people that are, we're all kind of in this together. In a world where, a lot of people don't even know their neighbors. Okay. This really, I couldn't be more proud of it. It's a port in a storm for people. and that alone is worth the $15 a month. So anyway, it's probably not the best, most fluent commercial I could give for my site, but I sure encourage people to check. I just feel like I said, you join us for a month. You don't like it, you're out a whopping $15. But I'm pretty sure you'll like it if you do.
Great. Well, I'll put a link in the description below to the TF Metals report for people who want to check it out. Thank you once again, Craig. It's always a joy to speak with you, and definitely looking forward to our next conversation as well.
Jesse, happy American Thanksgiving, Merry Christmas, Happy Hanukkah, Happy Kwanzaa. I mean, aren't all those things in December? Anyway, I'd rather rattle them off than say Happy Holidays. So enjoy some time at the end of the year, and we'll see you again soon, I hope.
Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.